Annual State of the Markets presentation. We're happy to have you here today, and we hope that we can share some important information with you. By the end of the webinar, we hope that you have a clearer view of our current situation and that you have some insights on what 2017 might look like. Let's get started. First, let me draw your attention to our disclaimers. These are always important things that we must put up there for all of our viewers and listeners. Hopefully you've had time to read through these, and let's get started. On today's agenda, what's happened in 2016? What factors might affect the markets as we move forward? What's on the horizon? And what do some of those financial experts tell us about 2017? Well, first of all, the financial world is incredibly complex. We're all bombarded with dramatic headlines and contrasting opinions. So our goal today is to educate you about some of the factors that we and expert financial analysts are watching. Of course, it would be impossible for us to cover everything, but we'll try and touch on the most relevant factors. And while past performance provides no guarantee of future results, we will focus on trends that might help guide the decision-making process as you're investing. So, let's proceed. What happened in 2016? Well, at the beginning of 2016, we were coming off of a year when all the major domestic indices lost a small amount of ground. In January, fears about China's economy were so strong that the Shanghai index dropped 6.9%. That was on the very first trading day of the year. The U.S. markets experienced their worst start ever to a year. By February, markets hit their bottom before rebounding in response to GDP revisions and consumer spending improvements. Growth continued at a relatively solid, but certainly not blistering pace before 2016's first major political surprise rocked them on June 23rd with Brexit. Few people expected the Leave group to prevail and the UK to vote in support of exiting the European Union. For 4 days, the global markets reacted strongly to this shock before stabilizing once again. But 2016 still had some curveballs in store for us. After one of the most divisive and hotly contested presidential elections in memory, the U.S. experienced two big surprises. First, Donald Trump won the election. Markets responded with near glee and launched a rally that would carry us through the year's end. Ultimately, the year ended with all major indices posting sizable gains, far from the doom and gloom that greeted us in January. But let's look at what took place. In fact, equities, in spite of that rough start, actually beat predictions, with the S&P up 9.5% for the year. But let's take a look at some of the interesting patterns that took place. For instance, look at financials, which was at the bottom for performance during the first half of the year, losing 3.05 in 6 months. But fast forward to the end of the year, where financials became the best performing sector with a 26.65% growth in the last 6 months of the year. Information technology was the second worst performer at the beginning of the year and second best by year end. Conversely, utilities did exactly the opposite. They went from being the second best performer through June and the second worst from July to December. Well, what do these reversals tell us? Diversification is the key. Knee-jerk reactions could have cost you dearly when sectors swing as widely as these did. Investing always involves risk and loss, including possible losses of principal. No investment strategy can guarantee positive results. So again, the key seems to be diversification. Well, what else affected the markets in 2016? Well, the labor market. In many ways, it was a good year for American workers. We experienced our 75th straight month of job growth. Unemployment dropped to 4.7%, less than half of its peak during the Great Recession. We're finally seeing labor market tighten and more people return to work and earn more money. While higher wages can affect corporate profits, they also drive consumer spending, which accounts for more than 2/3 of our GDP. Well, how about manufacturing? Well, the bottom line to this is that manufacturing output is going up. U.S. oil production is improving while the cost of producing oil has dropped. We're moving closer to a U.S. independence in the area of oil. Another way to think about manufacturing as well as oil and gas production is to consider the economic value they create as compared to global GDPs. If you look at this chart, the value of U.S. manufacturing production would represent the 10th largest GDP in the world, bigger than India, Canada, Australia, and the U.S. oil and gas would be the 17th largest economy. So manufacturers moving in the right direction. How about global growth? As we discussed earlier in the presentation, fears about China's economy were largely responsible for the market's volatility early in 2016. Add the concerns about Brexit and further disruption of the Eurozone and beyond, and you start to wonder what's really happening with the global economy. Of course, global growth still has a number of headwinds, and you really must evaluate markets on a case-by-case basis. But I think this chart does a good job of showing that global growth is picking up. The Purchasing Managers' Index is a heat map that measures growth and concentration in manufacturing. Red indicates contraction, while green indicates growth. If you can scan quickly, you'll see that the January 2015 column has more orange and red than the December 2016 column. Look deeper and you'll see positive progress for the U.S., the UK, Russia, Taiwan, and even China. In other words, this data shows us that global growth is picking up rather than threatening to decline. But what about inflation? Boy, that silent stealer of buying power. Let's talk about those trends for a moment. Inflation is a general rise in the prices of goods and services and is one of the key indicators of economic well-being. Though the relationship between inflation and the stock market is complex, generally speaking, stable, modest inflation is better for equities than high or volatile inflation. If you look at the box in the middle of the chart, you'll see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The federal government puts out this data and tracks price trends in a large number of goods bought and sold in the United States. The core CPI below it strips out volatile food and fuel prices to focus on long-term inflation trends. You can see that the light blue CPI line jumps around much more than the darker gray core CPI line. That's because food and energy prices tend to be very volatile in the short run. Though the past doesn't always reflect the future, historically, a sudden run-up in prices has often accompanied or been the precursor of a recession. Note the huge inflationary spikes during the 1970s oil crisis and the 80s recession. As of November 2016, the headline CPI of 1.7% was well below the 50-year average and very close to the Federal Reserve's 2% benchmark. The Fed has a mandate to foster maximum employment and price stability, and they believe a 2% rate can help support accurate financial forecasting and decisions while preventing harmful deflation. Consumer confidence, consumer sentiment. Though we're confident that the U.S. economy is on the right track, we know that the stock market doesn't always follow the economy. One major indicator that we like to look at to gauge the economy's health is consumer sentiment, which is essentially a survey that asks regular Americans how they feel about the economy and their financial prospects. It's an important indicator because sentiment has a strong relationship with consumer spending, which drives 2/3 of the economic growth. Sentiment can also tie to market performance, but in a more complicated way than you may expect. While consumer sentiment can be a rational reaction to a strong economy, a high level can also be a sign of irrational investor exuberance, which increases to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment. We see those recessionary periods on these charts as vertical shaded areas. Is that always the case? No. We can see it wasn't the case in 1984 or 2004, but it did happen in 2000 and 2007. For 2016, we ended with December's reading reaching a 12-year high. Later in the presentation, we'll show you reasons why consumer sentiment and the markets look fair, but we'll still keep an eye on consumer sentiment because it can indicate that the market could trend downward. I like how Warren Buffett phrases it. Be fearful when others are greedy, and greedy when others are fearful. What does that mean for us? Don't get too caught up in what others are thinking of doing. Be cautious, watchful, and prudent about managing risk, even when the crowd is going the other way. What's on the 2017 horizon? Well, there are some things that might say a positive view. Look at these headlines. U.S. reached energy independence. Economy takes off. Industries return to the United States. Our new presidential administration brings many questions about what the future may hold. We could find faster growth, better jobs, increased oil production, and more if these three factors happen. 1, the stock market performs well. 2, business continues to invest in the U.S. And 3, President Trump's policies accelerate the economy. In this case, we might imagine future headlines touting major accomplishments in a few years from now. But imagine the future with a negative view. Trump starts trade wars. Loose lending standards trigger hyperinflation. European Union is over. Ultimately, no one can predict the future, and 2017 brings a noteworthy amount of political uncertainty. We believe that to avoid emotional reactions during times like these, we must focus on the fundamentals. Look at what's really happening in the economy and analyze what the data is showing us. Whether real or imagined, headlines are only helpful if we take the time to think critically and look for truth amid the hype. Here are some market risk indicators as of December of 2016. These are things that can help us ground our predictions in actual data. As you can see, in December, the U.S. economic outlook was strong. Consumer confidence was growing, business spending was on the rise, and many more indicators showed positive signs. The only red on the board came from the political environment. Given the uncertainty about how our presidential administration will govern and what policies will come to fruition, this concern seems fair and one for which we will have more answers later this year. The yellow gauges are areas where analysts have some concern, and we'll continue to watch for developments, especially over the next 3 to 6 months. So we can see that the global economic outlook and the geopolitical risk both appears to be improving. Well, the picture isn't perfect, and the past can't predict the future. Financial markets don't always act in concert with the economy. However, barring some unexpected economic shocks, we're pretty confident that we won't see a recession this year. But what about equity values? Well, the markets have rallied since the presidential election, reaching one record high after another. But are investors too euphoric? Are equities overvalued? When we look at this slide's data, we see that markets actually appear to be at a fair value. There's a lot going on in this chart, and I don't want it to be too technical, but let's look at a couple of areas. One being PE ratios. Now, what does that mean? It means the difference between an economy's price per share, or P, and its earnings per share, or E. The higher the PE ratio, the greater the difference between what investors pay for a stock and what the company actually earns. So a high PE ratio means stocks are relatively expensive compared to what they are earning per share. If you look at the middle dotted line, you'll see that the average PE ratio is 15.9 times. In other words, over the past 25 years, stocks have averaged a price per share of 15.9 times their earnings per share. Now, during the Great Recession, the PE ratio was far below the average line, where it was high above the average during the dot-com boom. For 2016, we ended at a 16.9, nominally above the 25-year average, but still well within one standard deviation above average. This data tells us we do not appear to be in the middle of a bubble. Instead, stocks are currently at fair prices for their earnings. What about personal finances? Perhaps one reason for consumers' rising confidence is that their personal finances are improving. The percentage of debt payments people made compared to their disposable personal income has dropped, and the average household net worth has risen. We've seen a rise in serious delinquencies on auto loans and student loans, but total serious delinquencies have dropped significantly in the past several years. Overall, with rising wages, lowering unemployment, and increasing net worth, outcomes are looking up for the average consumer. What do financial experts predict for 2017? Well, one of the areas is inflation. As we discussed earlier, inflation is about 2.1%, but what's going to happen in 2017? If you can look at the chart, you can see expectations for inflation jumped immediately following the presidential election. If President Trump is able to lower corporate taxes, increase infrastructure spending, and loosen regulations, or even if just one or two of these goals are accomplished, there's a good chance the economy will speed up and inflation will rise. But even if inflation does rise in 2017, we don't expect it to reach uncomfortable levels, and the Federal Reserve still has a lot of room to adjust interest rates to help control inflation. What about interest rates? The Federal Reserve seems to share our view that the economy and inflation may both grow in 2017. After raising interest rates in December 2016, only the second increase in 10 years, Fed Chairwoman Janet Yellen said, "My colleagues and I are recognizing the considerable progress the economy has made. We expect the economy will continue to perform well." The Fed also said they may introduce 3 additional interest rate hikes in 2017, up from their previous prediction of 2 raises. Ultimately, rising interest rates are a sign that the economy is doing well. But what happens when interest rates rise? There's a lot of dots on this chart, but the green dotted line represents 5% yield on a 10-year Treasury note. If you're at the placement of the tan diamonds, you'll see that they're most clustered in the upper left and lower right quadrants. What this arrangement is showing us is that when rates are below 5%, equities tend to grow with rate increases. But when rates are above 5%, equities tend to decrease in response to rate increases. In other words, considering where we are with rates right now, history shows us that we may be able to expect the markets to rise as rates increase, as long as they stay below 5%. What about fixed income? One area of the market that may stumble when inflation and interest rates rise is fixed income. On the last slide, where we saw the correlation between rising interest rates and a rising stock market, the data also shows that this scenario can cause bond yields to rise too. While on first glance, increasing yields might seem like a positive scenario, yields and price have an inverse relationship. So generally, the more yield a bond provides, the less it's worth. Kind of like the teeter-totter that you see in this slide. After experiencing years of low interest rates, many investors may be surprised to see that their bonds can lose money. But a changing tide in the economy doesn't mean you have to abandon fixed income, because it's often an important part of a well-balanced, diversified portfolio that provide the income investors need. Instead, you should pay closer attention to what bond risks and opportunities exist, and closely watch inflation and interest rates in 2017. We'll also continue to monitor the geopolitical uncertainty that can significantly affect fixed income yields. After the December 2016 meeting, the Fed released its predictions for GDP and unemployment in 2017 and 18. As you can see, they predict that GDP will continue its steady, moderate growth, and unemployment will drop even further to 4.5%. The good news for workers is that this means if unemployment continues to fall in 2017, then wages should rise in response. As you can see on this chart, where the gray line is unemployment, and the blue line is wage growth. The two measures usually inversely relate, so when unemployment goes down, people can expect to earn more for their work. But let's get back to our predictors of the future. So these are experts forecasting for domestic equities in 2017. Various media outlets compile the S&P 500 price targets of Wall Street's top analysts. And let's see what they have to say about the S&P 500 this year. Now, these targets aren't ours. they are what experts are predicting, and you can see that 2017 estimates cover a 200-point range, from 2,300 from several analysts to 2,500 at RBC, proof that even experts often have differing opinions. But while they gave a range of results, one trend is consistent. Each analyst predicted that the S&P will continue to rise in 2017. That's good news. The average, 2,359, is 4% growth. Well, decent returns, but less than half of the 9.5 growth the S&P achieved in 2016. Of course, as we stated earlier in this presentation, we're not trying to foretell the future. No one knows for sure what equities will do in 2017, and predictions at this stage are still pretty foggy. However, these 12 analysts' perspectives show that optimism continues on Wall Street. What we need to remember is keeping a perspective. Boy, I often tell people, put on your seatbelts, we're going for a ride. We've gone over a lot, but what you need to take away from this, if nothing else, is that emotions have no place in investing. Over the past 8 years, we've weathered many storms, from the Great Recession to global pandemics to terrorism and beyond. And after all of these tests and all of the volatility, the market continues to grow and create new opportunities for you. As you can see on this chart of stock performance since 1980, the average year has a 14.2% difference between its peak and low prices. That's a big spread. One that we understand can feel quite unsettling in the moment. But even with these intra-year drops, the market has been positive in 28 of the last 37 years. Last year started terribly, and imagine what would happen if you'd let fear dictate your response, rather than logic and professional support. You could have missed out on opportunities to grow your wealth and pursue the future you desire. We expect 2017 to bring an improving economy, but there is also real potential for volatility. So if you ever feel concerned or want to understand what's happening, lean on us for support. We're here for you. We want to help you make the most of your financial life. So what should you do in 2017? We want you to move further towards your personal and family goals. If something changes in your life or personal situation, keep us in the loop. We want to hear about important family events like births and death. We also want to know about health issues, employment changes, and any financial developments such as an inheritance that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, please share your thoughts with us so we can help you pursue the life that you most desire. On the topic of specific financial life adjustments, we also want to know if you experience any changes in your feelings about risk, or if you have any concerns about the market environment. We're here to talk through whatever financial questions, worries, or excitement you may have, so that we can help you make informed choices and stay on track towards your goal. Finally, we ask you to go over your estate documents, beneficiary designations, and other paperwork to make sure that it's all up to date. A well-organized estate is one of the best gifts you can give your family. Now, what are we going to do for you? We're going to keep you informed through regular communication. We're going to manage your investments according to your personalized strategy. We're going to stay on top of changes in the market environment and make prudent adjustments when necessary. I know we've gone through a lot of information and that there's probably many questions on your mind. Remember, if you're wondering about something, there's a very good chance that there are other people out there also wondering about the same thing. So if you have a question, go ahead, call us, email us, get in touch with us. We're here for you, and we hope that this review of the past and look at the future has been of benefit to you today. Thank you for joining us.